RLX Technology missed consensus on both the top and bottom lines for Q2 2026. Revenue came in at 1.01 billion RMB, which completely missed the 1.15 billion estimate.
Yeah, the bottom line was just as rough. Earnings per share landed at just 0.167 RMB.
Yeah.
I mean, that fell far short of the 0.626 forecast.
Right. And forward guidance just poured cold water on everything. Mainland China sales are expected to be totally flat for the full year.
Exactly. And while Q3 is going to see the consolidation of a newly acquired Western European distributor, which will boost international revenue, management explicitly warned it's going to heavily dilute their gross margin percentages.
Which the market absolutely hated. Shares slipped like 4.5% to 6.5% in pre-market trading, and then gapped down to open around $1.85.
Down from a previous close of $2, yeah.
Yeah. So we are taking a deep dive into a stack of earnings transcripts, PR newswire releases, and analyst notes today to figure out exactly why RLX missed the mark so badly, and more importantly, what this means for you, the retail investor tracking this stock.
Because there are some massive structural shifts happening under the hood here.
Okay, let's unpack this. Because the paradox here is that despite missing Wall Street's 1.15 billion RMB estimate, which was obviously a very high bar, RLX actually grew revenue by 14.8% year over year.
Right, almost 15% growth, but the stock still gets punished.
Exactly. So to understand that top-line growth, we have to look at where that 1.01 billion RMB actually came from. RLX built its whole empire as a dominant Chinese domestic brand, But
that identity is basically gone now.
Yeah, it's gone.
It is a staggering geographic pivot. International business is now carrying the entire company. We're talking roughly 68.5%, so nearly 70% of total net revenues this quarter coming from overseas.
Which is wild for a company that used to be synonymous with the Chinese vape market.
Oh, absolutely.
Yeah.
But they are desperately trying to outrun the reality of their domestic market right now. China is facing severe regulatory crackdowns on non-compliant products.
Right, the strict flavor bans.
Flavor bans, plus an environment where the state tobacco monopoly just heavily controls the whole landscape. The domestic market is so hostile to growth right now that, like we mentioned, management is modeling a complete flatline.
Which obviously forces them to look outward. But, reading through the sequence of their quarterly filings, that outward expansion hasn't been a smooth ride either.
Not at all.
Going from Q1 of 2026 into this Q2 report, there was a severe 36% sequential deceleration in revenue. I mean, they basically hit a brick wall between March and June.
What's fascinating here is the underlying mechanics of that wall.
Yeah.
So management attributed this drop to what they called inventory normalization.
Which sounds like corporate speak for nobody bought anything.
Pretty much. But it masks a much more chaotic reality that happened in Q1. In the first quarter, they experienced this massive shipment pull forward.
Okay, let's translate that for a second. A pull forward usually means someone panicked and bought early, right? So why the panic?
Impending regulatory export adjustments. Yeah, in the international vape and tobacco market, wholesale distributors operate on razor-thin margins. So if there's even a rumor, like just a whisper, that a new compliance rule or shipping restriction or a slight export tax increase is going to hit next month,
They just stock up.
exactly.
Yeah.
Those distributors will empty their bank accounts to buy 3 months' worth of inventory today under the old, cheaper rules.
So Q1 looked artificially incredible because distributors were hoarding product. They essentially stole sales from the future.
Precisely. And when Q2 rolled around, those same distributors were sitting on warehouses just stacked to the ceiling with RLX products. They didn't need to reorder.
Right, they had plenty of stock.
Yeah, so the actual shipment volume from RLX factories dropped by 36% sequentially, while those distributors just worked through that massive backlog.
Okay, but hold on. If the Chinese domestic market is completely flatlining, I have a hard time believing their international products are suddenly just flying off the shelves organically to make up for that 14.8% year-over-year gain.
Right.
I mean, are they actually winning over consumers in Europe and Southeast Asia? Or are they just taking their cash pile and buying foreign companies to hide the fact that domestic growth is dead?
And that is exactly the critical question to ask when a company pivots this aggressively. The answer is, it's a mix. But it is heavily, heavily reliant on strategic acquisitions.
I figure.
Yeah. In the filings, they constantly cite this major acquisition they closed back in May of 2025 as a primary driver for this quarter's international growth.
So they're purchasing revenue streams?
Exactly. They are buying their way into these markets to keep the top-line graph pointing up.
Which, it feels like a Faustian bargain. You buy revenue to satisfy Wall Street, but buying growth is never cheap. If we look at the fundamentals, there's this massive fracture between what they are making on paper and the actual cash in their bank account.
It really is a tale of two completely conflicting financial metrics.
So let's start with the bright spot because it is a genuine win. Gross margin surged to 35.4% this quarter. That is a massive 790 basis point expansion year over year.
It's a huge jump.
Yeah, and gross profit rose 47.8% to 357.8 million RMB. So how exactly did they squeeze an extra 7.9% of margin out of a physical product in a single year?
Well, management credits supply chain optimization and higher manufacturing yield.
Okay, meaning less waste on the factory floor.
Right. Every component they buy is successfully turning into a sellable unit rather than ending up in the defect bin. And they also highlighted a favorable product mix.
So they're selling the higher markup models.
Exactly. On paper, it looks phenomenal. I mean, this marked their 11th consecutive quarter of positive non-GAAP operating profit, coming in at almost 150 million RMB.
Which sounds great until you look at the cash flow.
If we connect this to the bigger picture, it reveals a really troubling contradiction. Despite those stellar gross margins, operating cash flow turned negative for the second consecutive quarter.
They burned 63.2 million RMB just running their daily operations.
Right. So you have to ask, how do you report a 35% gross margin, hit your 11th quarter of operating profit, but watch your actual cash pile shrink by over 63 million?
Right, where is the leak?
It all comes down to operating expenses, which spiked to 227.5 million RMB.
Which is a huge jump from last year, so what's driving that?
Three main culprits, according to the filings: higher salaries, aggressive branding expenses to push into these new international markets, and a heavy hit from depreciation and amortization.
Which ties right back to that May 2025 acquisition.
Exactly. When you buy a company to juice your revenue, you inherit all their bloat. You take on their payroll, you spend millions integrating them, and you have to amortize the premium you paid to acquire them.
Here's where it gets really interesting for me. It's like, okay, imagine having a luxury restaurant that is fully booked every single night.
Okay.
They charge $100 a plate, and the food only costs $30 to make. That's your beautiful 35% gross margin. The restaurant looks incredibly profitable on paper.
Right. The unit economics are great.
But at the end of the month, the owner can't make payroll. Why? Because to open that restaurant in a new country, they had to prepay for a year's worth of expensive ingredients, hire a massive corporate marketing team just to get people in the door, and take out massive loans to remodel the building.
That is a perfect analogy. The daily operations are highly profitable, but the corporate overhead and global logistics are draining the actual bank account dry.
The working capital pressures are literally eating the gross margin gains.
Yeah, the cash conversion cycle is breaking down.
Wow.
Because of all that corporate overhead, their core profitability, the non-GAAP net income, actually declined.
Wow.
Yeah, it fell to 238.8 million RMB, down from over 291 million a year ago.
So even though they grew top-line revenue by 14.8%, they walked away with substantially less core profit.
Right. Now, looking at the U.S. GAAP net income, it technically ticked up about 1.6%, but we have to be very careful with GAAP numbers here.
Because of non-operating factors.
Exactly.
Which basically means accounting noise, right? Like interest income off their cash pile. It means they aren't actually making more money selling vapes. They're just making money off the cash sitting in their corporate treasury.
Precisely. The core operational reality is that they are spending significantly more to make less.
Which brings us to the management commentary in their outlook, because they are at a massive fork in the road regarding capital allocation. We know they're burning cash from operations, but they are also sitting on a massive war chest.
A huge one. As of June 30th, they reported 13.9 billion RMB in total capital resources. Cash, short-term deposits, liquid investments.
Which translates to roughly $2 billion US.
Yeah, 2 billion.
With $2 billion, you could fix the supply chain, you could aggressively buy back shares, or you can double down and buy even more growth. And looking at July, they chose option 3.
They definitely doubled down. In July 2026, RLX acquired a 51% controlling stake in one of Western Europe's largest distributors of next-gen smoke-free and FMCG products.
So they didn't just buy another vape brand, they bought the actual distribution pipes.
Exactly. Warehouses, logistics fleets, deep relationships with convenience stores across Europe.
Which, guarantees your product gets on the physical shelves, which is huge in an industry where you can't really run traditional advertising. But going back to our Faustian bargain, this is going to wreck their margins, isn't it?
It is a profound structural cost. Management stressed this forward-looking commentary very heavily.
Hmm.
When this European entity is consolidated into the financials in Q3 2026, it will significantly boost international revenue,
Okay.
but it will lower the overall gross margin percentage because wholesale distribution inherently carries a much lower margin profile than brand ownership.
Right, because a distributor doesn't own the intellectual property. They're just moving boxes.
Exactly. A brand creator like RLX operates on that beautiful 35% margin. A wholesaler operates on like a 5% to 8% margin. It's a volume game.
So when you blend those two businesses together, the overall corporate margin is going to plummet.
Management explicitly warned investors to brace for margin dilution in Q3.
It's just wild to me. They spent the entire Q2 call taking a victory lap for expanding gross margins by 790 basis points, and in the same breath, told the market to ignore it because they just bought a low-margin wholesaler.
It's a survival tactic.
Yeah.
They are actively trading their profitability profile for market access because China is flatlining.
Did they mention any other strategic moves? What about new product categories?
Yeah, CEO Kate Wang emphasized pushing into oral nicotine pouches.
Okay, diversifying away from just traditional e-vapor.
Right, because pouches bypass a lot of the respiratory concerns, making them slightly more resilient against sudden regulatory bans.
Makes sense. And what about the U.S. market? I mean, that's the white whale for international revenue.
The U.S. market remains completely on pause.
Really?
Yeah, investment is strictly limited pending regulatory clarity. The FDA process is just too slow, too expensive, and totally unpredictable right now.
Which is probably smart, honestly. Don't throw good money after bad. But let me push you on this $2 billion cash pile again. RLX has historically touted that they've returned over $500 million to shareholders.
Yes, they have.
But if I'm a retail investor holding this stock at $1.85, I want to know if my dividend is safe. Are they going to keep buying low-margin distributors or reward shareholders?
Well, management reiterated their intent to distribute non-GAAP net profit as dividends.
Ah, but there's the catch.
There's the catch. You pay dividends out of the bottom line, not the top line. And as we just discussed, non-GAAP net income just shrank.
Because of the massive OpEx from their M&A strategy?
Exactly. So the success of this new European integration is absolutely critical to maintaining those dividend payouts. If they can't run their high-margin products efficiently through those new distribution pipes, that dividend is going to be under intense pressure.
So, wrapping up this Q2 narrative for you, the retail investor trying to make sense of the conflicting signals today, RLX is in the middle of a massive identity shift.
A radical evolution, really.
Yeah. They're pivoting away from China to international markets, transitioning heavily via M&A and boasting great gross margins while simultaneously struggling with negative cash flow and high OpEx, which is exactly why the stock was punished today.
This raises an important question for investors to mull over. As RLX shifts from a high-margin brand owner to a lower-margin European distributor just to buy growth, at what point does it stop being valued as a high-growth tech or vape company and start being valued like a traditional, slow-growth consumer goods wholesaler?
That is the multi-million-dollar question. Because if your margins look like a wholesaler, eventually your stock multiple will too. It's a structural shift you need to monitor closely when Q3 rolls around. And for daily, no-fluff earnings coverage tracking exactly these kinds of shifts, make sure you hit follow on the show. We'll see you next time.